Welcome, everyone. In the high-stakes world of venture capital and angel investing, a single number, the valuation, often dictates the fate of a deal. But where does that number come from? Most use a discounted cash flow, or DCF model. However, a DCF is only as good as its assumptions. Today, we delve into sensitivity analysis, the process of quantifying valuation risk. We aren't just looking for one correct price. We are looking for a range of outcomes that inform smarter investment decisions. By the end of this session, you will understand how to move beyond static models and embrace the dynamic reality of market fluctuations to protect your capital and enhance your returns. Before we can stress test a model, we must understand its foundation. A standard DCF relies on projecting free cash flows over a 5 to 10-year period and discounting them back to the present value using the weighted average cost of capital, or WACC. We then calculate a terminal value to represent the business's worth beyond the projection period. While the formula seems precise, it is highly sensitive to even minor adjustments. A 1% change in your discount rate can swing a valuation by millions. This inherent volatility is exactly why sensitivity analysis is not optional. It is a mandatory layer of due diligence for any sophisticated investor. The biggest mistake an investor can make is falling in love with a base case scenario. When a founder presents a pitch deck showing a $100 million valuation based on a 10% discount rate and 3% growth, they are giving you a single point in an ocean of possibilities. Market conditions change, interest rates pivot, and growth targets are missed. If your entire investment thesis relies on those exact numbers holding true, you are exposed to significant downside risk. Sensitivity analysis allows us to ask, what if, providing a safety net by identifying which variables have the most outsized impact on the final valuation result. The most effective way to communicate sensitivity is through a two-way data table, often called a heat map. This table pits two critical variables against each other, usually WACC and the terminal growth rate. By looking at this grid, an investor can instantly see the valuation across a spectrum. For example, if the discount rate moves from 9% to 11%, while growth drops from 4% to 2%, the table will show exactly how much value is eroded. Green cells represent a buy zone, where the valuation remains attractive, while red cells warn of overvaluation. This visual tool transforms abstract risk into a concrete roadmap for negotiation. While growth is important, the weighted average cost of capital and exit multiples are often the most sensitive levers. WACC reflects the risk profile. A startup in a volatile sector might require a 15% discount rate, whereas a steady-state enterprise might only need 8%. Similarly, the exit multiple, what you expect to sell the company for relative to its earnings, can drastically alter the terminal value. In our analysis, we test a range of multiples, perhaps from 8x to 12x EBITDA. Understanding the sensitivity of these two inputs ensures that your entry price accounts for potential shifts in the macroeconomic environment and industry-specific exit trends. It is important to distinguish between sensitivity analysis and scenario analysis. Sensitivity analysis changes one variable at a time to see the impact. Scenario analysis, however, changes a cluster of variables to reflect a specific narrative, such as a global recession or a tech breakthrough. A bear case might assume high inflation, higher WACC, and low adoption, lower growth, simultaneously. By combining both methods, investors gain a multi-dimensional view of risk. You aren't just seeing how one gear turns, you are seeing how the entire machine performs under different environmental pressures, giving you the confidence to commit capital even in uncertain times. Once the sensitivity analysis is complete, we look for the margin of safety. This is a concept popularized by Benjamin Graham, suggesting we should only invest when the price is significantly below the intrinsic value across most likely scenarios. If 80% of your sensitivity table shows a valuation higher than the current asking price, you have a strong margin of safety. If the deal only works in the top left corner of your heat map, the most optimistic settings, then you are gambling, not investing. This data-driven approach allows us to walk away from perfect-looking deals that are actually fragile and double down on robust deals that withstand scrutiny. In conclusion, DCF sensitivity analysis is about more than just numbers. It is about clarity. It allows you to enter negotiations with a deep understanding of value rather than just a feeling. It empowers VCs and angel partners to quantify the what-ifs and move forward with conviction. Remember, a model is a map, but sensitivity analysis is the weather report. You wouldn't set sail with a map alone. You need to know how the wind and waves might change your course. Use these tools to protect your downside, capture the upside, and ultimately drive superior investment returns. Thank you for your time, and let's go build some value.